What if I told you there's a tiny company trading at just a few dollars, quietly building parts for some of the most powerful military machines in the world, and almost nobody is paying attention? This isn't hype, this is something most investors completely overlook. And by the end of this video, you might see this stock very differently. This company doesn't show up in headlines, it doesn't trend on social media, and it doesn't get talked about every week. But behind the scenes, it's deeply connected to the defense industry in a way most people never realize. And that's exactly why it's dangerous to ignore. Because here's the twist. It doesn't build full fighter jets or complete systems. Instead, it focuses on something much more critical. It builds the precision parts that major defense companies depend on. And in the defense world, that matters a lot. Because suppliers of critical components are just as important as the final manufacturers. If these parts fail, entire systems fail, which makes trust extremely valuable. Think about it like this. A fighter jet is only as strong as every single bolt, bracket, and landing system inside it. One weak component can compromise the entire aircraft. That's why companies in this space don't just sell parts. They sell reliability at the highest level possible. We're talking about landing gear systems, engine components, and structural aircraft parts. The kind of components that must perform perfectly under extreme conditions. Once a company enters this supply chain, it becomes very hard to replace. Because switching suppliers in aerospace isn't like switching brands on a shelf. It involves certifications, testing cycles, regulatory approvals, and years of proven performance. That stickiness is one of the biggest hidden strengths of this industry. So today we're breaking everything down. What this company does, how it earns money, why it's struggling, and whether this is a hidden opportunity or just another risky penny stock. But before we reveal the name, you need to understand the business model a bit deeper. This company operates in precision aerospace manufacturing, which is a highly specialized industry. It produces engineered components used in aircraft, helicopters, jet engines, and defense systems. These are not cheap products. They require advanced engineering, strict certifications, and long testing phases before they ever get approved for use. Even a small defect tolerance can take months or years to validate. That's why entry barriers are extremely high in this industry. New competitors cannot just walk in and take market share. You need experience, trust, and long-term contracts. Most of the company's revenue comes from defense contracts and aerospace programs. Many of these are long-term agreements, which can provide some stability even if growth is slow. And stability is one of the most important factors in defense manufacturing because governments don't just buy once. They maintain fleets for decades. That means ongoing replacement parts, repairs, and upgrades. But here's the issue. Despite being in a strong industry, this company is still trading like a penny stock. And that immediately raises questions about its financial health, execution, and long-term survival. Now the company we're talking about is Air Industries Group, ticker symbol AIRI, and this is where the picture becomes clearer. Air Industries Group is a US-based aerospace and defense manufacturer focused on precision components. Its products include landing gear parts, engine mounts, flight control systems, and structural aircraft components. In simple terms, they don't build the final aircraft. They build the critical parts that make those aircraft functional. And that puts them in a supplier position, working with larger defense contractors instead of competing against them. They are involved in military aircraft programs, helicopter systems, and jet engine components, including platforms like Black Hawk helicopters and other defense systems. So yes, this is a small company, but it is directly connected to large-scale defense infrastructure. And in industries like this, even small suppliers can become extremely important when demand increases. However, now we need to talk about the risks, because this is where most people get surprised. Revenue has declined in recent years, which is a major concern. Profitability is inconsistent, and margins are often weak or negative. That means even when the company is generating sales, it is not always translating into strong earnings. The company also faces financial pressure, including cash flow challenges and dependence on winning new contracts to stay stable. That kind of structure creates volatility, especially for a small-cap stock. There is also the issue of scale. Larger defense contractors have more bargaining power, more stable contracts, and stronger balance sheets. Smaller suppliers like this often operate on thinner margins and tighter conditions. But here's the interesting part. Global defense spending is rising, especially in areas like modernization, aerospace upgrades, and military readiness. And when that happens, the entire supply chain benefits, not just the big companies but also smaller suppliers. Even a small increase in contracts or efficiency improvements can significantly impact a company of this size because it doesn't take billions to move the needle here. It takes relatively small changes in revenue. However, execution is everything. Being in a strong industry does not guarantee success. The company still needs to improve operations, control costs, and turn revenue into consistent profit. Despite the challenges, the company continues to win contracts, including multi-million-dollar defense deals. That shows the industry still trusts them enough to award business. And in defense manufacturing, trust is everything. Once you lose it, you rarely get it back. But once you earn it, you can stay in the ecosystem for years. Another important shift is their focus on aftermarket services. This includes maintenance, repair, and support for aircraft already in use. Aftermarket revenue is important because it is more stable, more predictable, and less dependent on new production cycles. Instead of relying only on new contracts, companies can earn from maintaining existing fleets. If this strategy works and aftermarket revenue grows, combined with rising defense demand, the company could gradually stabilize and improve its financial position. But if revenue continues to fall and losses persist, the stock could remain under pressure or even face further dilution risks. And that's the reality of high-risk penny stocks. So let's be clear, this is not a safe investment. This is a turnaround situation where success depends heavily on execution, management decisions, and industry timing. You are looking at a company with real contracts, real products, and real industry exposure, but also real financial problems that cannot be ignored. And that's exactly why this story is interesting. Because the market hasn't fully decided what this company is worth yet. It is stuck between being a forgotten small cap and a potential turnaround story. Most people will ignore it because it's small, quiet, and not trending. But sometimes, big moves start in exactly these kinds of overlooked places, long before the market notices. And that brings us back to the real question. Is Air Industries Group a hidden opportunity positioned to benefit from rising defense demand and long-term contracts? Or just another struggling company that never manages to fully turn itself around? That's something the market will decide over time. But now, at least, you understand the full picture.